This episode is intended exclusively to provide information and education to help individuals better understand cycles. However, this information is not be construed as professional advice as to the buying and selling of securities or other investment instruments. In no event does the host express any opinion with respect to or make recommendations regarding the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading securities. Buying and selling decisions are solely within the personal discretion of each individual.
From the mind of Lars von Thienen, the most advanced cycle analysis, hot off the press.
Welcome, fans of the cycle analysis, to another episode of Cycles TV. My name is Lars von Thienen, and every week, Monday, same place, same time, we meet here to discuss some cycles. Today, I want to discuss a very interesting topic, the financial stress index. So financial stress as a series. And for sure, we are interested in the questions, are there cycles in the financial stress, and how can we use that cyclic information in terms of what it means for the stock market or the US global financial industry. So that's the purpose of today. Just upfront, I'm enjoying some days off at exactly this point in time, so I needed to pre-record that video. We have our holiday season here in Germany, and therefore today I'm with my family and enjoying some time off. So I cannot take your live questions today, and this was pre-recorded, 1 or 2 weeks ago. But this is a weekly series, so I'm analyzing now the weekly impact of that data series. So let's switch to the chart and let's discuss what this data set is about. So first, this is the data source. So let's talk about for a second on the raw data series. It's coming from the Federal Reserve Bank of St. Louis. So they provide these economic data and economic indicators. They call it their financial stress index. You can grab that data from their web service for free. And just in short terms, this financial stress index is a composite measurement, I think out of 10 to 20, maybe 12, 18 individual financial measurements which are available. And they monitor these financial conditions for the US economy. And based on these 12 financial indicators, they build a composite score. And this composite score is then charted here or called the financial stress index, which has a value from 0, even below 0 to something. And the reading is if you have high financial stress figures, so these high peaks here, these correlate to market times when the financial industry was under high stress, high pressure. And you need to read these points in time vice versa to what's happening in the stock market. So extreme situations, which a lot of financial stress in the system often correlates to bottoming or moving down stock markets. And the extreme points then vice versa correlate. So a top in the financial stress index correlates to a market bottom in the US or on the US stock price charts. And we will check this on the stock price charts also in a second. So it is a good data feed, which helps us to have another view on the US stock markets. And what is even more interesting is not the absolute value, because if you just view this as an absolute data set, it's not as meaningful, because sometimes these values can go as high as here close to 10. Sometimes these values just stay from an absolute level very low. Sometimes even you don't have exact low points. So while saying that, lows in the financial stress then vice versa correlate to market tops in the US stock markets. So the absolute value is not really useful on timing or identifying situations, because it is always seen relative to the left or to the right. So is this high from an absolute reading? It's not high. Is this high? Or even, let's go back into the internet bubble in the year of 2000 or 2001. Is this low? Which I'm hovering here. Is that a low? So from an absolute view on the chart, you would not see a major low here. But in relative terms, to the left and to the right, you see here's the top, then we move down. So relative to the left and right of that situation, this is a low point we reached here in the year of 2000, 2001. And a low, in relative terms, is a market top. So if we find a way to identify the relative, let's call it swings, in that measurement, that's more important. So that's the first takeaway. You need to keep in mind that the absolute values are not of much information to identify turns in the US stock markets, but their relative swings, this information is important. But how do we detect these relative swings? These relative swings would be able to detect if we can find underlying cycles in that data series. So hopefully now you get the reason why this data set is interesting. And I think financial stress should be a very interesting data set in regards to cycle analysis, because financial stress will not jump abruptly from low to high and then back from high to low. This financial stress slowly increases and slowly decreases. So it is a cyclic behavior. If there is a dominant cycle, we don't know yet. But I think in terms how this value changes, it is flowing around maybe a relative mean. So it's not jumping. We don't have abrupt changes in that data series. So the question, final question, and this is what we will analyze next now with our cycle analyzer. Are we able to detect a rhythm, a dominant cycle in that financial stress index? Because if so, that would be interesting. So hope you get now why this series is important. So let's now jump to the cycle analyzer. And by the way, we have prepared a wrapper to get that data in our cycle analyzer. So I've just loaded the financial stress here into our cycle analyzer. This is up to last Friday. It's a weekly data series. So we have the data here for until 14th of June. This was last week, Friday. But anyhow, as it is a long-term analysis, it's not much important. And you can chart that data on your own. You see the ID here at the upper point. So FDS is the abbreviation for that data feed. And you use the same ID as it is named in the FRED data source, minus W. It's just the information that this is weekly data. So you can all chart that information on your own. If you are a member of the foundation, this will bring you to exactly this chart here. So now on the left screen, we see the financial stress index, which I just showed you a second ago on the FRED data source. So here you see the peaks. So as I said, the raw data is not as useful. So now let's look into the spectrum and let's check if we find cycles. The easiest way, as always, is let's use the peaks we see in the spectrum here down below. The spectrum is the first place to check if we can find dominant peaks in that case here. So the first one, at least from a visual perspective, which pops up, the highest amplitude, now that's the level I'm looking here, is at that point in time 186 weeks. Then there might be another interesting peak. It's a shorter one, but it also looks interesting. So let's start with these two here. At least there are shorter ones here to the lower left. You see interesting peaks here from a theoretical perspective, but these cycles I would have only a view at a second. guess, because they are much shorter than these higher amplitude cycles. So they could become important from a short-term perspective, but you always should start with the more longer-term dominant cycles here, which is why I pick these ones first to generate a spectrum view for us here in that case. So let's start, before we conclude, let's start with the 186 cycle, which is this most important peak we see here. Let's have a quick view how this aligns with the previous rhythm of the data series. And I think you will clearly identify here together with me that this has a nice alignment. Yeah, or we can even go into the past here. So here's a low, here's a top, which is here. Here's a, as said, look out for relative lows. So it is here. But by the way, that low we can even zoom in here. So you see it here from the relative perspective, right? So here's the previous top, here's the next top, and this is the relative low. That's what I said. You only can see this if you have this relative view of that data. So this is a low, not in absolute terms, but in terms of the cyclic behavior, this is a low. And this is also detected by that time cycle. And you see that time cycle here is at the start of the year of 2000, which is in alignment with the internet bubble top in the markets. We will switch to the markets in a second. So you, as said, you need to read this vice versa in regards to the stock markets. So then you see the next alignment here with this top, quite nice here. Yeah, this period here, zooming in. So this was skipped, but at least this is then the clear next low. And you see what an interesting peak in financial stress and timing of that financial stress cycle. And then here we have, we will analyze this also in a second here, but this is also from relative terms. You need to read this way. This is a low. This is the next top. This is a low. So yeah, that's the timing. If we would use the cycles, which in relative terms fits, not in absolute terms. So it's not easy to spot this just by looking at the absolute value. But then moving forward here, you see in 2016, the top, then the clear low in November, December 2017. Then we have another peaking here. The major raw peak is a little bit off, but if you would, you see the clear next low here on that perspective. Then what a nice key peak here at that timing. I think we had some stress in some mid-sized banks in the US at that point in time. And now we're looking into the future here with that point in time. So that's why I'm charting that cycle. It has a very nice correlation with major tops and bottom in the financial stress index series. And the reason I'm bringing this up here is we are interested in what does the future perspective look like. And this is indicating a major bottom in financial stress at the end of this year. And if you follow previous long-term analysis for the US economy, this is in alignment with a lot of other long-term cycles I'm often showing you. So it looks like we have a big cycles cluster coming up starting in September. I think the first long-term cycles top out in September, and then more tops come in until this financial stress cycle here running in the top into December. So I think into the US elections and after the US elections this year, the long-term cycles seem to really become negative. And keep in mind, the upswing of financial stress means downswing on the US stock prices. So if the financial stress will show up early next year, or at least start to increase next year, this could be then trigger the change in trend on the US stock prices here. So that's the main reason I'm showing you that information. A second reason is if you go a little bit deeper in that data series, I want to highlight also the harmonics. You know that if you use cycles for analysis, the harmonic relations between different cycles plays an important role in cycle analysis per se. And we have built in an harmonic, at least view to that data series, which shows you the harmonic correlations between, or connections between different cycles, which is shown here. And if I just hover over the cycle which we are using, so the 186 week cycle, you see highlighted here which cycles, so which other cycles which have been detected by our cycle scanner have an harmonic relation to that cycle. And you see that we are looking out, and you can pre-configure this for your own needs. We are looking for harmonics with a factor of 3, 2, and exactly half and a third. So these are the major harmonics, and we allow a deviation of 8%. So from a mathematical point of view, we are not looking for the exact harmonic relation. We allow an error rate of 8%. Otherwise, it would be too scientific here. And with these parameters, you see this is a visualization of which cycles are related to each other. You can also hover over other cycles, but you should always start with the most dominant one and then maybe check what are the next harmonic relations to that cycle. And you see now I would take more attention to the shorter term cycles, as we have two cycles which have an harmonic relation to the 186. And this is the 59 and 66 week cycle. And they are both having this harmonic relation by the factor of 3. So with the error rate allowed of 8%. So these two shorter term cycles seem to have a relation to that cycle. And then always you should use those two cycles to add that to the mix. So these are listed here in the table, so I can add that to our composite. So now I have added these two cycles in addition to the long-term cycle, so that the composite has the main dominant cycle and the two harmonic related cycles here in that. And by doing that, and you need to invest a little bit more time for the research on that. But what I want really to show you is, if you remember on, now this will come in a second. If you remember, give me a second here. Yeah. And we will see this at the price chart in a second here. For example, we have a double bottom here at this point in time, which shows us we should see maybe two tops later in the markets here. And you see this is also double tops here from the financial stress in that sense here. And this is what you see very, very often, at least at major turning points. You just don't have one point and then it turns. You often have two kind of tops or bottoms, often in alignment with some divergences in these markets. So by bringing in these three cycles, which is more or less one cycle with their harmonic relations, we see that it even better helps to shape the general view on how the financial stress behaves. And you see, we don't get a much complex composite here. We see instead of having just one top or one bottom, we see that the shorter term cycles bring into that one cycle the double tops and the double bottoms, which for financial stress. And also, let's see in a second if this is also vice versa seen in the price series. So that's why I brought this harmonic relationship in. But we don't trade financial stress, right? So financial stress is just nothing we can use in our trading environment, but it gives us a clue what we expect the financial stress will continue. And with that information, we have some kind of clue what might happen in the US stock markets, right? So Therefore, now let's switch to a price chart, and I will show you those cycles now on a price chart next. So I will open a price chart here, or let me hide the cycles for a second. So this is, and I'm using here the Wilshire 5000. I think this is much better than using the Dow Jones with just 50 stocks or the S&P 500 with just 500 stocks. And you know, these days they are heavily more or less skewed by these magnificent 7, which the S&P 500 is not really a measure of the broader market. It's more a measure of these 7 heavyweight topics. But if you use the Wilshire 5000, which uses around, I think, close to 4,000 individual companies, it's not that much skewed as the S&P 500. So there, I think, for the general analysis of the US stock market, it's during these times, we should not use the S&P 500. We should not use the Nasdaq. The Wilshire 5000 is a better, broader market indices if we are dealing with this long-term cycle. So that's just said upfront using the Wilshire 5000, which is the blue. So this is the US stock market price chart in general. And let's now overlay the financial stress cycle here. So I have already prepared. We can export that composite cycle from our cycle analysis engine. We can import that cycle here. And this is what I've done. So what you see here is you just see it as a zigzag plot. So it's just kind of timetable, just connecting the bottoms and lows of the cycle you saw in our cycle analysis engine. This then results in this zigzag plot here. And I have also inverted that chart. So let's just look here. So if you remember, the analysis showed the high of the financial stress here in March 2023 and the low of the financial stress in December 2024. If we invert that, we would like to see on a price chart the low or an interim low in March 2023 and the projected high at the end of 2024. So now let's switch to the price chart. So this is what we see here. You see the low in March 2023 and the high at the end of this year. So just to show you, it's now inverted and it's shown as a zigzag. All right. So, and now we can also zoom in how the plots align here to major tops. We can even go back. And this is what I said. So here you see a clear alignment of that timing with the top of the internet bubble by using that cycle. And if you remember, if we just switch back to the raw data here in the year of 2000, this would be hard to spot, right? So that's what I said. The absolute value reading from the raw data would not give you any clue here. But using that data now, using our cycle analysis and the relative swings, you see that this low was a key cycle low in the financial stress, and it was a perfect hit of the internet bubble timing high here. Not only that, also timing the first low here. I mean, then this leg was clearly off, or at least there was no key low here. Then this top was the top or the start of the financial crisis in 2007. Yeah, and even the bottom, you see perfect alignment of when we hit the maximum stress level in regards to timing, also timing the low in the stock market here. Then here, this interim low in the year of 2016, you see how clearly this is aligned to the timing of that cyclic low here. I will come to this. Yeah, this was also, you could call it an interim top here. But this period was really hard. I will come back to that in a second. Here you see the top here, which was pre-indicated already in summer 2021. It took a little bit longer for the stock market then to top out here. But also the low, which we all had hard times to identify if this low in the stock market here, if we would have used the financial stress cycles, they would have helped us in March 2023 already to tell us that this will be a financial stress a top, so a market low, and now we are in the final leg and that's what's interesting for us, which seems to conclude end of this year. So November, with the US elections, the financial stress should find its bottom, or its final bottom, before it starts to increase, what would indicate then a long-term downward movement in the US stock markets. So that's my first point. The second point, I want to show you the beauty of harmonics here. And I've also transferred, if we add these 3 cycles, so this is the composite cycle view on the financial stress, and I've also transferred that information here to the price chart. Don't be irritated, as I said, it's just connecting the tops and bottoms, so it's not the cyclic curve you see here. It's more these swings just connecting from top to bottom. And the beauty of the harmonics, and that's why I brought it in, is here. So now it gets really interesting. As I said, this period, just looking at one cycle, which had the low here, was not of help for us. But now including the 2 lower harmonics of that cycle, you see that there was a double bottom, which really happened in the markets here at that point in time. Yeah, so here we had the low. I mean, not the exact point, but this is what we would have expected. Then a topping again here, and then a drop again here into this. So, I mean, these lines have nothing to do with the price. This is the projection of 3 cycles on financial stress. And so adding these 2 lower harmonics to the longer term cycle really helps us fine-tuning shorter movements. Even as I said, also here. So now you see in the single cycle view, it looks like the top of the financial stress was too early here already in summer 2021. But now you see the secondary harmonics gave us a second date of a possible top here, which was then more than perfect. Yeah, and we can even now move back with these harmonic relations. Also, I mean, look out how the harmonics helped us to shape also this top here. I mean, that's the beauty of cycles. I mean, that's more or less impossible. So the first major top came in here a little bit too early. It helped then even to move down this point here. And then you see, okay, there should be a second top coming at that point in place. And this really then kicked off the major financial stress crash here in the year of 2007, 2008, bringing us to that timing the low here. Yeah, and this is what's always really interesting. I mean, not every move of the financial stress cycles helps out, but you see this interim low here. So it's fascinating how it really helps to even this double top here in the year of, yeah, this is the internet bubble here. In the year of 2000, as I said, you won't be able to spot this top on the raw data of the financial stress. You see these sub-cycles here, so that there have been a double top, which the first top would have been expected here. I mean, how perfect is that? But we would have expected a secondary top from a timing perspective here. You see even how perfect is that. So, and this is what often happens at these key major tops of the markets. There's not just one turn on the markets. You might see a double top or something like that. Not always, but it shows the power of how harmonics, cycle harmonics, improve a composite reading. And especially if you're looking from a timing perspective on possible turns you would expect in the markets. So finding the dominant cycle and then stacking up with harmonically related shorter term cycles really give you a better picture. So that's why I put some attention to that theory of cycle analysis. Now you see what this means on the price chart. So it's not only theory, it's really, really useful to look into harmonics. But now we are here also to get a clue what to expect in the future. So let's move to the right. So this is even with the subharmonics. By the way, before I go to that, it's also fascinating here. It showed us to expect a kind of short interim top here, which we saw in July 2023, with a quick drop, but then this long-term upswing, which then started, it started in October, but it would also have guided us to that longer upswing. But this comes now to an end, and it doesn't matter. So that's now the final comment. It doesn't matter if we just use the single dominant cycle or if we use a composite cycle out of 3 cycles. And that's also important. If these scenarios align, it doesn't matter if it's January or December. That's in terms of nominal cycles, that's the same timing here. And you see, even using the 3 harmonic cycles would give us a longer duration for the next downswing than the single cycle here. And it doesn't matter, this point in time is showing up in September 2025. So the reading here is quite clear. The financial stress cycle expects a major bottom in the financial stress, which we could transfer to an expected key top in the US stock markets by end of this year. And this clearly is a correlation with the other long-term cycle models I've here reviewed with you. So the time into the US elections might cause some heavy swings, but maybe it's a little bit too early to call the bull run to end today. And I hope you like that episode, because I used, to sum it up, I used a different data set. So I did not primarily analyze cycles in the Wilshire 5000s to derive the cyclic behavior. I used a different data set. You should think about what other stress, or it's kind of emotional data set you can use. I think if you find these kind of data sets, it's much more important than just using price. Second, I showed you finding the longest dominant cycle, and then afterwards adding the harmonic relations to that cycle into the mix will really help you to fine-tune these little, what you call it, if you just have a look at this single cycle, the little skews to the left or the right, which then often are called, the cycle is wrong or it's too generic. If you bring in the harmonics, shorter term harmonics, it will fine-tune how exactly the shorter term moves are. I hope, and you can apply this to any data set. So I wanted just to show you how perfectly this looks on the financial stress. And third, use that to create a projection, a forecast, which might help you then if you look now on the price chart or prepare your trading algorithms. This can guide you in regards of timing. So hope you liked it. That's the financial stress index. You can chart it in our cycle analysis engine on your own. Let's see how this will continue into the end of this year. Thanks for joining me today. I will hope you will also join our next sessions, where I will be live again, back from holiday, so more relaxed, more interested in taking your questions. For now, I also hope you enjoy a little bit the summer period, at least here in Europe. So thanks for listening. Have a nice time, and see you here on the channel. Bye.